October 3rd, 1913. President Woodrow Wilson signs the Revenue Act, resurrecting the federal income tax after a 20-year absence. 9 weeks later, December 23rd, 1913, the same president signs the Federal Reserve Act into law. Two instruments, 77 days apart. One extracts wealth from labor. The other controls the currency that labor is paid in. Most Americans have been taught these were reforms. They were not reforms. They were architecture. And once you understand what was built in those 77 days, you stop seeing the economy as a level playing field, because it was never designed to be one. The game of wealth accumulation is not neutral. It was engineered with specific winners in mind. And the rules most people are handed are not strategies for building wealth. They are strategies for maintaining a predictable, taxable, manageable middle class. Save more, spend less, max out your 401k. Trust the long-term market. That advice is not wrong. It is incomplete by design. Over the next several minutes, you are going to see the structural difference between the rules most people play by and the rules that govern how generational wealth is actually built. Not theory, not conspiracy, mechanics. The modern economy does not function unless you spend. In the United States, personal consumption expenditures account for roughly 68% of GDP, a figure that has climbed steadily since the 1960s. The machine requires consumption the way a furnace requires fuel. So the machine was engineered to produce it. In 1957, marketing researcher James Vicari claimed he could trigger purchases with subliminal messages in movie theaters. The claim was later exposed as fabricated, but the industry it inspired was not. Today, behavioral economics has replaced the parlor trick with precision. Researchers like Drazen Prelek and Duncan Semester at MIT demonstrated in a now famous 2001 study that consumers are willing to pay up to 100% more for the same item when paying by credit card instead of cash. The pain of payment is neurologically blunted. Spending becomes frictionless. Richard Thaler, who won the Nobel Prize in Economics in 2017, spent his career documenting these distortions: mental accounting, the endowment effect, present bias. Every one of them has been weaponized by modern retail, modern finance, and modern media. Planned obsolescence, originally proposed as an economic strategy by real estate broker Bernard London in a 1932 pamphlet called Ending the Depression Through Planned Obsolescence, is now a product design principle. Your phone is slower after 2 years because it was built to be. None of this is accidental. It is the infrastructure of a consumption economy, and the people who built that infrastructure do not participate in it the way you do. The people who profit from your consumption are not consuming the way you are. Open the Internal Revenue Code. Earned income. The salary a nurse, a teacher, a software engineer receives in exchange for hours of their life is taxed at rates climbing to 37% at the federal level, plus payroll taxes, plus state taxes. In high-tax states, the marginal rate on labor can exceed 50%. Now look at long-term capital gains. The top federal rate is 20%. Qualified dividends, the same. Carried interest, the mechanism by which private equity and hedge fund managers are compensated, is taxed at those same capital gains rates, despite being, in economic substance, compensation for work. That loophole has survived every administration since 1954. This is not an oversight. It is preference, engineered into statute across generations of lobbying by the people it benefits. The consequences are measurable. A 2021 ProPublica investigation, drawing on leaked IRS data, found that the 25 wealthiest Americans paid a true tax rate of approximately 3.4% on their wealth growth between 2014 and 2018. During the same years, a median American household paid an effective federal tax rate roughly 4 times higher. On income, a tiny fraction of the size. A surgeon earning $600,000 a year pays a higher effective rate than a fund manager earning $60 million from investment returns. A middle manager contributing to a 401k will eventually pay ordinary income tax on every dollar withdrawn, while the family that owns the office building she works in pays capital gains on appreciation, borrows tax-free against the equity, and steps up the cost basis to market value at death, erasing decades of gains for their heirs. This is the single most important structural insight in personal finance. The wealthy do not earn their way to wealth. They own their way to it. And almost no one is taught the difference. There are 2 kinds of debt in the financial system. One is sold to consumers. The other is used by wealth builders. They share a name. They share nothing else. Consumer debt transfers wealth upward. As of 2025, Americans carry more than $1.1 trillion in credit card debt, with average interest rates above 21%, the highest since the Federal Reserve began tracking the data in 1994. A balance carried on a depreciating purchase is a machine that manufactures poverty. The asset loses value. The interest compounds. The borrower pays twice, once to the seller, continuously to the lender. Leverage is a different instrument entirely. When a real estate investor borrows at 6% to acquire a property that appreciates at 7% and yields 5% in rental income, the math inverts. The debt is tax advantaged. Mortgage interest on investment property is deductible. The asset generates cash flow. The tenant effectively services the loan. The appreciation belongs to the borrower. Private equity operates on the same principle at scale. The leverage buyout model, pioneered by firms like KKR in the 1980s, uses the target company's own assets as collateral for the debt used to acquire it. The 1988 takeover of RJR Nabisco, $31 billion, the largest LBO in history at the time, was built almost entirely on borrowed money. The returns flowed to the equity holders. The risk sat on the balance sheet of the acquired company. Same instrument, opposite outcome. It depends entirely on which side of the architecture you are standing on. Understanding the architecture does not require dismantling it. It requires recognizing which side of each system you currently operate on and making deliberate decisions about which side to move toward. The transition from earned income to owned income is not instantaneous, but it follows a recognizable pattern in nearly every significant wealth accumulation story in modern economic history. Thomas Stanley and William Danko documented it in The Millionaire Next Door, published in 1996 after 2 decades of research. The typical first-generation millionaire is not a high earner. They are a business owner, a landlord, or a professional who converted earned income into owned assets with ruthless consistency over 20 to 30 years. Economist Thomas Piketty formalized the same pattern in Capital in the 21st Century. His central equation, R greater than G, states that the return on capital historically exceeds the growth rate of wages. Over long time horizons, ownership compounds faster than labor can. The data runs back to the 18th century. The pattern does not break. What this means in practice is simple and uncomfortable. Every dollar of earned income you do not convert into an owned asset is a dollar that will be taxed at the highest available rate, eroded by inflation, and never work for you again. Every dollar you do convert into equity, into real estate, into a business, into an income-producing asset begins operating under a different set of rules: lower tax rates, appreciation, cash flow, leverage, time. The wealthy do not stay on the hamster wheel. They build exits from it. And the exits are structural, not motivational. You are not supposed to know this, not because of malice, but because the system functions more smoothly when most participants follow the rules they were handed without questioning who wrote them, when, or in whose interest. The game exists. The rules favor specific players. And the first step toward playing differently is not working harder inside the existing rules. It is understanding the board well enough to see where the exits are. Next week, the psychological profile of the people who successfully cross from one side of this system to the other. What they think differently about money, about risk, about time, and the specific cognitive shift that precedes every transition from earner to owner. Subscribe. You are going to want to see it.